Americans now owe $1.277 trillion in credit card debt, the highest amount ever recorded since the Federal Reserve began tracking it. Here's what makes that number genuinely disturbing. The average credit utilization rate across the country has now climbed to 36%, above the threshold where your score actively starts to take damage. And over 10% of all Americans saw their FICO score drop by 50 points or more in a single year. Not because they missed payments, not because they took on new debt. Many of them did everything right, paid on time, paid in full, and still watched their score fall every single month. If that sounds familiar, it's not bad luck. It's not a glitch in the system. It's one specific mechanic that almost nobody talks about. And once you understand it, you can flip it completely in your favor. Until you know about that one specific day on the calendar, it's going to keep happening to you, no matter how responsible you are. Here's what I'm going to show you today. Why your score drops even when you pay on time. The one day that actually controls your credit score. The 1% rule that separates people with good credit from people with great credit. And the exact step-by-step process to put all of it into action starting this week. I'll also share one extra move at the end that most finance channels completely skip over. And it could make a real difference if you're trying to qualify for a mortgage or a major loan. Chapter 1. How the system actually works. Here's what most people think happens. They swipe their card, spend some money throughout the month, the bill comes in, they pay it, and the credit bureaus see a zero balance, a clean slate. This is not how it works. The credit bureaus do not watch your account in real time. What actually happens is that your bank takes a single snapshot of your balance once a month and sends that snapshot to the three major credit bureaus, Experian, TransUnion, and Equifax. That number gets locked into your credit report for the entire month. Here's the problem. That snapshot gets taken before you ever get a chance to pay. Your billing cycle runs for about 30 days. During those 30 days, you're buying groceries, gas, subscriptions, maybe a few bigger purchases. At the end of those 30 days, the billing cycle closes, your bank generates a statement, and that statement captures the balance at that exact moment. This is called the statement closing date. That balance is the number sent straight to the credit bureaus. Then, about 25 days after the statement closes, your payment is actually due. So, you might carry a $2,500 balance that gets reported to the bureaus on the 30th. You pay it in full on the 20th of the following month. Zero interest, never late, but the bureau's already locked in that $2,500 before you paid a single dollar. Chapter 2. Why utilization is so powerful. Now here's why that one number matters so much more than most people realize. Your credit score is made up of 5 categories. Payment history is the biggest at 35%. Right behind it at 30% is something called amounts owed, almost entirely driven by your credit utilization. Nearly 1/3 of your entire credit score is based on how much of your available credit shows up on that snapshot on that one specific day each month. Under 30% is considered acceptable. Under 10% is where better scores actually live. Here's the dollar and cents reason this matters. The difference between a 680 score and a 760 score on a 30-year, $400,000 mortgage can cost you over $60,000 in extra interest over the life of the loan. That's not a rounding error. That's a car. Utilization alone can be the thing separating you from that rate. But here's the part that surprises most people. This does not just apply to your overall credit usage across all of your cards. It applies to every single card individually. You can have $50,000 in total available credit. But if one card with a $600 limit is maxed out, your score takes a hit from that card alone, regardless of how low your other cards are. Utilization has no memory. Unlike late payments that can sit on your report for up to 7 years, utilization resets every single month. Fix the number this month, and your score responds this month. There is a newer scoring model called FICO 10T that does track your balance trends over time. But FICO's own data confirms that 90% of top US lenders are still using older models where utilization resets clean every month. So, this strategy is still fully in play. Chapter 3: The Strategy. So here's the move. Instead of waiting for your bill to arrive and then paying it, you pay before the bill has ever been created. 3 to 4 days before your statement closing date, you log into your credit card account and manually pay your balance down to a very low number. When the closing date arrives, the bank generates your statement and captures that low balance. That is the number sent to the bureaus. Here's exactly how it plays out. Your statement closes on the 15th. On the 11th, your balance is $2,000 on a $5,000 limit. That's 40% utilization. You log in and pay $1,900. Your balance drops to $100. The bank generates your statement showing $100. That 2% utilization is what gets sent to Experian, TransUnion, and Equifax. When your due date arrives, you pay the remaining $100. Zero interest, and the bureaus received a great number. You're not cheating the system. You're just taking control of when the photo gets taken. Now, here's where most people make a second mistake. They assume that if keeping a low balance is good, zero must be perfect. It's not. Reporting zero balances across every single card every month means the algorithm doesn't have enough data to score your behavior accurately. People with scores at or near 850 carry an average utilization between 1 and 6%. The strategy for hitting that sweet spot is called the all zero except one method. Pay all cards down to zero before the statement closes. On just one card, leave a tiny balance, something like $10 to $20, roughly 1% of that card's limit. This tells the algorithm two things. You are actively using credit, and you are keeping it extremely low. No interest, just a better score. Chapter 4: Step-by-Step Action Plan. Step 1. Find your statement closing date on every card. It's not the same as your due date. Go to your Statements tab, open a past bill, and look for Billing Cycle End Date or Next Closing Date. Step 2. Set recurring reminders 2 to 3 days before that closing date. Bank transfers can take 1 to 2 business days to post. You need that buffer. Step 3. On your reminder day, log in, check your balance, and pay everything above 1% of your card's limit. Do not rely on autopay for this step. Autopay posts after the statement closes. It does not help you control what gets reported. Step 4. Pay the remaining small balance by the due date. You can use autopay for this part. A missed payment, even on a $10 balance, does far more damage than any amount of high utilization. Step 5. Keep your spending within your credit limit each month. If you're constantly maxing out your card, the real fix is requesting a credit limit increase. Call your issuer. Explain that you pay in full every month and ask for more room. A higher limit naturally lowers your utilization without any extra steps. Step 6. Bonus. Especially for mortgage/auto loan applicants. Ask your lender about a rapid rescore. This is a service where your lender submits proof of your updated balances directly to the credit bureaus and can get your score updated in as little as 3 to 5 business days, instead of waiting a full month. It doesn't work for every situation, but if you're about to lock in a rate, it's worth asking about. This is the complete system. Find the closing date, set a reminder, pay it down early, leave 1% on one card, pay the rest by the due date, and repeat. And remember, with the national average FICO score now sitting at 715 and the average American carrying 36% credit utilization, most people are unknowingly in the danger zone. You don't have to be. Start with just one card this month and watch what happens to your score. If your score is still stuck despite doing all of this, if there are collections, errors, or outdated negative marks dragging you down, utilization alone won't fix that. That's a different problem that needs a different solution. Drop a comment below and let me know if you want a full video on exactly how to clean up a credit report from scratch. I'll see you in the next one.